Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
And we know it takes time, right? Because we're not that big institutional fund that could just go gobble up deals to establish a presence. It's got to still be a good deal for us to enter the market. Right. So we know it's going to take time, but we also know that it's worked every time we've done it, where we put the time in for whether it's a year or two consecutively into that market. When we land that first deal, we end up landing deals 2, 3, and 4 fairly quickly to solidify our presence in that market.
Hi, I'm Alex McDermott, host of The Multifamily Method, a podcast that explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
Hi, I'm Richa. Thank you for joining us here today. We're going to be speaking with Chris Urso. Chris is the founder and managing partner of URS Capital Partners, which he founded in 2007. Chris took the company from humble beginnings to accumulating over 4,000 units with an asset value of over $400 million. He will be giving us some insight into his background personally and how URS Capital Partners was founded. Additionally, he will provide us with some insight into how his company has grown into what it is today and where he plans to take the company in the future. Welcome to the podcast, Chris.
So can you start and just tell us a little bit of your history, like where you grew up, born?
Sure. So from Huntington, Long Island, grew up in kind of the prototypical middle-class family. My dad worked in the city for 45 plus years, commuted to and from on the train every day. My mom ran the household, kind of your middle of the road prototype Long Island family. Went to Manhattan College, so stayed in New York for pretty much most of my life. Still live there now. Spent a little bit of time in New Jersey when we got married, just to get away from the family for a couple of years. And we're still there. That's our home.
Gotcha. And you have a couple kids, right?
Yeah, 2 kids, 8-year-old and a 10-year-old. My son's 10, my daughter's 8. Big hockey family, big Ranger family.
It's awesome seeing them play some hockey.
Yeah,
skating around. Where do you think you got your work ethic from? Was it a single person? Was it watching your dad go in, day out in the city?
So I think, a lot of it came from probably college experience. We never went without as kids by any means, but it was, Christmas was one pair of sneakers or that jersey, not like kids today where my son's getting a new pair of sneakers every month and whatever jersey he wants. But, my dad worked hard to give us kind of, that lifestyle where my mom didn't have to work. She could be around. But then once I hit college, I think that's when things kind of opened up. Started working at the bars at college, became friends with a bunch of the older guys, the guys that own the bars. And, really the only job I ever had after college and bartending was working for one of our good friends that opened up a business in Manhattan. Litigation support business. So we did copying, scanning, printing for all the top law firms in the city. And that was a 24-hour business, 7 days a week. So we only closed on Thanksgiving, Christmas, and New Year's Day. Wow. And I stepped into the operations role right out of college, and you were on, 24/7. I had Nextels. You guys are probably too young to even know what a Nextel is, but that was like our first wave of cell phones. And I got the biggest one because I was the youngest guy. The thing was this big, and that thing would go off 2:00 in the morning. Lisa and I were living together at that time, and I'd get in a car and drive into the city, because something needed to get done. And I think that really kind of opened my eyes to, if you want to build something great, you really need to kind of be all in and kind of work your ass off for it.
Yeah. And eventually that sold, and that's kind of how you got out of it.
Yeah.
So then what created the interest in real estate?
So the interest in real estate started actually while I was still working in the city. Ended up reading Rich Dad, Poor Dad. A buddy of mine gave me that book while I was commuting to the city, living in my parents' basement, about 2 hours each way on the train. And read that book about 3 times, probably in 2 weeks, and then gave it to Lisa and said, you need to read this. And we went to my parents as my college gift was going to pay off my student loan it was like $25,000 at the time. And I'll never forget sitting down at the table with them I said, listen, well, I got an idea. What if you don't pay off the student loan? You give me the $25,000. I was introduced to some guys that were buying 2 families, renovating them, renting them out to Section 8 tenants in Paterson, New Jersey. And Lisa and I had gone out there a bunch of times, and they had a house ready to be sold, and said, you guys want to buy it? And I said, yeah, let me figure it out. So I convinced my parents at the kitchen table, after they'd worked so hard to make sure I didn't have student loan debt, to give me the $25,000 to put down on this 2-family in Paterson, New Jersey. And, my mom had every reason why we shouldn't do that. What if somebody slips, they fall? What if this breaks, that breaks? I said, what if I get hit by a bus? Yeah. And then we went and did it. We got our blessing, and I was making $800 a month in cash flow living in my parents' basement. And that I fell in love with real estate at that point, and continued to work full time at Skyline for about 7 years. In 2007, that business was sold. I'd worked myself into a little piece of equity. So I got a couple of bucks on the sale of that. And then Lisa and I decided to push into real estate full time. It was kind of our passion. We had done probably 6 residential deals in and around New Jersey during that time, and done well on them. And we pushed in 2007, and the world imploded about a year later.
So how did that affect what your holdings were back in 2007, 2008?
Yeah. So again, coming from a non-institutional background, right? So the company I was working for in college, we were as gritty as grit can be. I didn't have any institutional experience, finance experience, really. So we had a little bit of cash. So with the world imploding, there was no credit out there for a guy like me to get started out. And I either could buy one deal in the New York area, or I can look for other markets where I could try to get in there and build some velocity up. So we ended up in Cincinnati, actually. That's how I know Stash for probably much longer than you guys know.
Oh, no.
And we started buying actually cheap foreclosures in Cincinnati. In 2008 and 9, we bought about 60 houses. I'm talking about houses for like $7,000, $10,000 that we would clean up, rent them out to either Section 8 or market rate tenants. And, we learned a lot. But the biggest thing I learned was that there was no way I was going to be able to scale a business. I was ahead of the curve. I want to put that out there, by the way. I was doing single family before Blackstone and, American Homes for Rent, everybody else. I just didn't have the capital behind me to really scale it. So we realized after about 2 years of doing that, there was no way we were going to be able to build a sustainable investment business buying these $20,000, $30,000 homes. And we pivoted over to multifamily, bought a vacant 40-unit building for $260,000 in Cincinnati, and renovated it, had it leased up in 8 months, and we haven't looked back since. It's been, purely multifamily.
Did you just throw a dart at the map, or why Cincy?
No. So there was a couple of factors, right? Back then it was stability, right? Because it was, like nothing that, we'll hopefully ever see in our lifetime again. 2008, 9, 10, 11 was a really, really dark time. There was so much uncertainty, so much, distress in every market, and lack of liquidity. And we were looking for a stable market to be in, right? Where New York, the coastal markets were so volatile at that time. And Cincinnati had, more Fortune 500 companies, per million people than any other major city, steady home prices, no real peaks and valleys. And that's what attracted us there. And it was a large MSA, over 1 million people to kind of get our feet wet, and much lower entry point than, the coastal markets at the time.
So you sold out of Cincy now, right?
Yeah, we you guys actually sold our last deal. What, about 2 years ago now?
I think it was 2 years ago.
Yeah.
What is attracting you to markets now? If it was the stability back then, like how are you looking at that now?
So we cut our teeth in Cincinnati. We ended up doing about 4 deals there, 3 being smaller, 20 to 40 unit type deals, and then the 228 unit that you guys sold for us. And after doing that, we were looking for more growth opportunities. Once we got confident, we were able to kind of, raise some more capital, do a Fannie loan, get that kind of experience behind us. We actually set our sights into Charleston, and we were fortunate enough to hit Charleston at the right time, early on in this cycle. And now for us, it's more, I think, long-term fundamentals in the markets and good growth story, especially now more than ever, where everything seems to be so tight. We kind of have 3 checks. Do we want to own this asset for 10 years? Do we want to be in this market for 10 years? And is the deal capitalized well enough to hold it for 10 years? And if we can't do that, answer yes to all 3 of those, we're probably not buying it. We've always been more location centric and market centric than asset centric. You guys know, we'll go up and down the food chain, buy a vacant deal or, 2000 built deal if there's value there, if it's in the right location for us.
Right. And you touched on your fundraising. Can you walk us through that, what that's looked like and how that shifted from when you first got started out and, there was no money like out there at all to now where you oversubscribe on deals and hard to make room for your broker friends.
Yeah, it's we'll always make room for you, Alex. In the beginning, it was when we actually started raising some money when we were doing the single family homes,
right?
To get some leverage there. But it was anybody who had a heartbeat and 10 grand that would listen to our pitch. Pretty much, I would send out 100 books to friends. I took out my wedding list actually for the first capital raise, and sent everybody on the list our deck, which was basically looked like an 8th grade book report compared to the decks that we do now. And just picked up the phone and started pounding the phones, and it was awful and, uncomfortable, but did it. And then, we've kept our head down. I spent a lot of time out there, building our reputation, building our brand amongst, investors locally, and now, a little bit more on a national level, but through doing one deal at a time and kind of staying focused and being patient, it's the avalanche effect. It took a while. But we've built a fantastic database of, 150 plus active investors. And then through referrals and relationships and track record, now we have a great mix of ultra high net worth, private capital to high net worth to kind of, we still have our folks that invest in, $50,000, $100,000 in every deal that we do since inception. And we'll never look beyond that or forget about that because they're the ones that were there early. So we always try to make room for them. And one thing that's certain, our values, Lisa and I are very aligned on, is that we're not an institutional shop. It's the one thing I could probably say: we will never go institutional.
Right.
We like our family-run business model, our entrepreneurial kind of spirit, our nimbleness, and our equity appreciates that. And we've done a great job servicing that clientele. Both the high net worth and ultra high net worth guys appreciate the level of attention that we put into our reporting and our communication. I think it's critical. We've always treated it like, whether we were doing $1 million deal, we treat it like it was a $50 million deal, right. In terms of how important it was to communicate with our equity.
Yeah. So like, this is a question I always kind of have ask guys, is it the guys that write the bigger checks or the smaller checks that are the bigger pain in the butt when you're trying to execute on a deal?
It's funny because everybody thinks that like, especially when we have family offices call us all the time, or some of these like private equity shops, like, oh, we can write, 95% of the check. You never have to deal with anybody again and all the aggravation. We set up our business with such a investor focus so early that I don't get calls or text messages or, voicemails from investors saying, hey, what's going on with my investment? How's the deal going? We have been so diligent, 22, 23 deals later, 10 years later, every single quarter, updates on every one of our deals go out. Like, no matter what's going on in the world, what's going on with the deal, how good or bad it is, what's going on in my life, whether it's COVID or a recession or I'm having a kid, those updates are going out. So we had one rule from the beginning that is kind of like our mantra on investor relations. We never want an investor waking up wondering what's going on with their money. That's invested with URS Capital. So if somebody's calling me saying what's going on, I can point to, hey, we sent out the update last week. It's on our investor portal. You must have missed the email. Go back and check your email. Happy to talk through it with you. I talk to our investors all the time on a proactive approach, but I'm giving you kind of a long answer because, I think it's how you treat your relationships, and the natural thing is obviously the guy and we tell people flat out, like, if this $100,000 is earmarked for your daughter's wedding 3 years from now, don't give me your money. Like that's not going to be a good fit. Right. Hold off, wait till you can get to that point. But we're very, very strategic in our growth and in our relationships, both on the deals that we buy and also the investors that we choose to work with. So I think that's important.
Yeah, I think from what I've seen as well with your investor reporting, like even when the tough times do happen, like COVID, right? You've stepped up that reporting and it's fully transparent, which is awesome to see. You don't get that from every guy in our business. I think it's pretty rare. And with that, kind of on the topic of struggles, like COVID has obviously been a big issue this year. What kind of, I guess, struggles have you had to work through since starting URS back in, you had a recession and now full circle into another recession, right? So
I think starting in 2000, it was a blessing and a curse, right? It was awful to go through. I mean, we were literally living off credit cards. Lisa was commuting 2 hours each way to kind of keep us afloat to a job in Jersey City, which I'll forever be grateful for. But I think that's always held me for better or worse. And you and I have this battle all the time, very defensive and very guarded on not getting too far ahead of ourselves. And, I look back, I wish I got a little further ahead of myself over the last 5 years.
Every deal I show you is a great deal.
I know, every one. It's amazing. You have the Midas touch. So, the struggles are, I think in the beginning was on the financing side, right? Needing to bring a partner in to get that next level of agency financing. And we still sometimes have to bring partners into that side of it to make that happen. And we're fortunate we have a good base again of, high net worth and ultra high net worth investors that like to participate on that side from time to time. Operationally, management was obviously a big struggle in the beginning. We don't do in-house management. We're very, very active asset managers, but it was a big milestone for us to be able to consolidate our management with First Communities a couple of years back and be able to set up the structure where we can have where we can operate our business inside of theirs, basically.
Right.
And I think that's been a big game changer for us, where they give us autonomy on our deals. We have dedicated regional managers, dedicated assistant regionals, service managers, full access to our sites that are exclusive to us. But when I need the help of going into a new market like Tampa that we don't own, right, I can pick up the phone and call them and get connected with a regional that's local to down there. So it's kind of the best of both worlds. And then I think, right now with COVID, we prepared for the worst. I just was talking to Mike on the way here. I'm like, man, I think I got this a little wrong. He's like, well, that's not so bad. That means things are going a little bit better for us than we anticipated. We really buckled down early. I mean, it was daily calls on collections for probably 3 months straight with our sites. And we're seeing collections dip a little bit, but occupancy is increasing. So it's kind of offsetting a little bit of the collection challenges. And we still expect things to get a little bit worse before they get better. I think for us, the big struggle has been kind of the balance between not growing too fast and wanting to grow, to be honest with you.
What are some of the safeguards that you've put in place during this year to make sure that things don't go awry?
Yeah. Well, I think it starts with on the front end of every acquisition, right? And you guys hit a 12 cash on cash. I probably hit a 6 in my underwriting. And a lot of that has to do with, and I struggle with this sometimes with some of our investors that invest in multiple sponsors, right? I'll get these guys are clipping a 9 or 10 yield. I'm like, that's great. Let me know how it goes in 5 years.
Right.
Is that still going to be a 9 or a 10, or is it going to be a capital call? Because I can hit that 10 yield in day one, but I'm going to probably have to do a capital call in 3 years because we're not going to be capitalized appropriately for this deal. The safeguards is the front end cash that we bring. Our average LTC in our deals is probably about 66%, where we might go in with 75% agency financing, but we're bringing a huge slug of cap on top.
Right.
It's operating reserves, contingencies, capital reserves in our underwriting. That's allowed us to be confident going out during something like COVID and tell our investors I have, anywhere from 3 to 6 months of operating reserves in each deal in cash. And that's not just operations, it's operations, debt service, and CapEx reserves. And that allows us to play offense, in times where others are focused on playing defense.
Right. And I think you've done a pretty good job of playing offense this year. What would you say your average number of deals per year that you buy over the last 5 or so has been? So
I just went through this. We do anywhere from 3 to 4 deals on the buy side, kind of every 12 to 18 months. And as you guys know, it's, we might go 6 months and think we're never going to buy another deal. And then you end up doing 2 or 3 deals in a matter of, 6 or 7 months.
Right.
But that's kind of been our sweet spot, is 3 to 4 deals every 12 months. I'm happy with that. This year we had a big year. We had our biggest year ever.
Yeah.
We sold 3 deals, have a new development and lease up in Portland, the OZ side. We have Rock Hill, another OZ deal development, and then we have Nova Ridge. It's all happening kind of simultaneously.
And another under contract.
And another under contract, yeah.
in the midst of a pandemic, right?
Yep.
In the midst of a recession, you're still hitting that total number of deals, which is impressive.
So you talked about Rock Hill, and I actually, it's funny. I got a phone call from another buyer in the market who was like, do you know this Urso guy? I'm trying to figure out how he's like shifting into development. Has he ever done development before? So just tell me a little bit about how I know you're working with AJ and Bo on it, but just how you decided to make a move to expand into development, because it's not always a natural transition.
Absolutely. So again, very cautious. We're value add guys, as you guys know. Existing assets that we can come in and do, either heavier or moderate lifts to. It really stemmed from the opportunity zone. Tax benefits, right? We immersed ourselves in that very early, knowing our investor base on the high net worth side, and realizing that there was going to be a need for that, that this clientele, this investor base was going to want this. And I wanted to learn it really early. And this development has always been in my heart. Like it's something I've always wanted to do. And this was kind of the perfect storm for us to accelerate those plans. And, after kind of studying it, learning it, working with our tax attorneys, and putting word out, we wanted to do it on a very bespoke basis, right? Very unique opportunity. I'm not trying to become a developer. I wanted to add development to our platform. And we were able to get introduced to our first project up in Portland, Maine, actually the other way, through one of our investors to a local landowner, very sophisticated guy, real estate guy, construction background, had just gotten a piece of land fully entitled. And said, hey, you should talk to my buddy, Chris Urso. You guys might be a good fit. He was an older guy. He'd never done something of this scale, 256 apartments, and went up and met with him. The property was fully entitled. So all that pre-development risk was off the table, which was attractive to me coming into the space new. I was able to step in and make tweaks to the project based on our operating background and our experience with First Communities. And at the same time, able to leverage his, 30 plus years of local experience in dealing with municipalities and construction relationships and GCs. And we're now, a year and a half into that deal. And our first building's open. We're pre-leasing great. And, we're under budget and it's going well. And then, looking for the next project, we wanted it to be something, again, where we see the value in a local partner. And that's really how this happened. We were at a golf outing with Bo, and we're talking about Portland, Alex and I, and he's like, oh, we just got one in RFP and, Rock Hill, it's in an OZ. I'm like, let's go. We went right after the golf outing. And I think for us to make that segue to kind of come back to your question is looking for a unique opportunity where we can leverage the right local partner that shares the same values for the things that we don't have in-house. All that pre-development experience, the entitlement experience, the zoning experience, the local relationships with the third parties, and use those relationships and us bring our operating and equity platform to that deal and form a very fair joint venture where, we have the controls that our equity is going to be comfortable with, but I'm able to leverage that relationship for peace of mind and to mitigate my risk of, coming into new development at this stage of our business. And I couldn't be happier.
How do you see that progressing? Do you see that as being a larger part of the business in the future, or is that it's going to be deal by deal? And like, how do you perceive that?
So I think it'll continue to be deal by deal. Again, we're not trying to become developers. It's happened. The progression of our value add deals has led us here. I think that's an important note, though, too, Jad. Like, when we were doing our Portland deal, investors, this is your first development deal. Yes, it was, but our value add deals had gotten deeper and deeper and deeper over the years. Up to and including, vacant redevelopment of 144 units, 288 units. So it was a natural progression to that as the next step. But I think, for us, we want to stay true to, it's got to be a really unique, special situation where we can step in and bring our resources, our skill sets, and our operating platform to make that deal, from a good deal to a great deal.
So you're not going to...
Sometimes those deeper value adds can have more like construction variance than ground up, right?
Yeah. No, and we're seeing, especially in today's market where, cap rates are so tight on existing deals that, if you can find that right development piece and, and plan for things to take longer and cost more on your underwriting and still have the deal pencil out, you are mitigating against some risk. The tail. That's why finding stuff that's entitled for us was important on the development side to take a lot of that pre-development risk of both time and cost off the table, right? Where we can step in and move fairly quickly from contract to shovel in the ground inside of a 12-month horizon was kind of critical for us.
Yeah, it makes sense.
I think that goes kind of back full circle for you with everything that you've done, right? Flipping houses.
Yeah.
Building that up to 44 unit deals that were pretty deep value add up in Cincy, right?
Yeah, very.
Got out of those.
I think Stash sold it 3 times later after I did. What's even crazier is what might go even more full circle is that, we're close. We're not there yet. We're actually looking at a large scale build to rent single family development.
Oh, really?
Which would be really ironic, right? We got our start in kind of these one-off rental houses, and to come out and maybe be able to put together a 200 to 300 unit single family build to rent development is very exciting for us.
I think that's an interesting space moving forward, and I think it's a topic for a lot of groups right now. So I think it'll be interesting, and I'd like to get your take on it too, like where you see that space going. Like what kind of product would you be building there? What does that look like?
So it looks like basically a fully amenitized garden deal.
Okay.
That has, a variation of 2, 3, 4 bedroom homes, single, maybe 3 or 4 different styles of homes, very tight, small lots, front yard, backyard, garages, very functional floor plans, but you have your centralized clubhouse, pool, gym, all those amenities, and bring the operations and the customer service mindset of operating multifamily to that single family space. And I think in the right markets, all the research that we've been doing, it's obviously a very hot topic right now.
Right.
Everybody's talking about it, but to be able to find a site, again, a unique situation where you can do something of scale in one location and get to a point where you can do 200 to 300 homes in one location, I think is very rare and very unique, right? And that's what's exciting about it in one of the top MSAs in the Southeast.
I think it'll be interesting to see. You're a little bit different, but like on an exit scenario, you're probably keeping that as more long-term if you were doing that.
And it's an OZ deal.
And it's an OZ, so
it makes it even more exciting.
Yeah, exactly. Yeah. But as an exit, like it's, you can pro forma that, right? But there's really no trades that have occurred yet.
Yeah.
So that probably makes it a little bit more difficult. Then on the lender side, that's another layer of difficulty for those deals, right? Because not a ton of them have been proven out. So I think it'll be an interesting space. And for rent townhomes are another super hot topic right now.
That's probably your closest from a comp set, if you can find, right? A for rent townhome development in the, anything north of 100 units. The lenders are obviously getting more aggressive, right? The agencies are getting into the space. All the big dust lenders are there.
Yep.
At this point, they've created platforms dedicated to this space. There's billions of dollars of capital being raised to go towards this space. The demos are there for it. It's the exits could be interesting, right? Because you're afforded different options on the exit, but it's interesting, I guess. Is one way to put it.
That poses some interesting financing components too, because if you want to look at a individual exit strategy, you've got to really bake that into your financing on the front end so you can get a release schedule.
Exactly. 100%. And I think the way that we're not trying to get too cute with it on the first go.
Yeah.
We're trying to look at this as if it's a, institutional grade garden development, and pricing it very similar to how that would price on a cap rate basis.
Yeah. I don't think there's really any discount. And it just brings me back to selling Crowfield Village.
Yeah.
And a lot of the feedback that we got there, and so it's also expenses are unproven too, right? Mm-hmm. So a lot of the feedback there was it's going to be more expensive to maintain it. You have so many more roofs, so much more siding, windows, just more stuff to go wrong, right? Whereas a garden product, exactly what those expenses are going to be, and it's really pretty vanilla at this point.
It is, but I think in where you see it, so that's one of Lisa's main concerns is, how do you underwrite the turn costs on a 3-bedroom, 2.5 bath home. But I think one offset is, the data is pointing to a much stickier tenant base.
Right.
So versus your average of 50% turnover, you're probably doing about 30% turnover, if that,
right,
from what we're seeing. I think your expenses are, you're talking direct bill water, direct bill trash, direct bill sewer.
Right.
So you're taking those line items off your ownership operating expenses, which I think is huge.
Yep.
Your landscape maintenance is going to be higher, for sure. But outside of that, the discussions that we've had and the deals that we've been looking at as kind of case studies, it runs very similar. Just embedding and accounting for that turnover, I think, is probably the biggest one. And that's ingrained in us from our single family days back in the day.
Right. But your chunk rents on the flip side of that are significantly higher.
Yeah, 20 to 30% we're seeing in most markets.
Right. So
what on construction cost basis is that, on a per door, is it higher or lower than a garden?
It's
project?
higher. It's pretty significantly higher. The site work is really the main thing, right? You're going laying out 200 pads and infrastructure for, 200 homes is where we're seeing that number be, significantly different than a garden development.
Awesome. Well, I think we're going to take a quick break and we'll be right back.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
So I think one thing, Chris, that you've done really well, and I try to tell this to new guys that are getting into the business, but I can't remember how many years ago it was, but you basically called me up, said, Alex, I want to get on a weekly call with you. And even if we don't have anything to talk about as far as deals, like, you're always staying top of mind. So I think, and I'd like to hear your view of it, because all of your broker relationships that I know of, you're really close with those guys, right? So what have you done, and how did you early on figure out that fostering those relationships was going to, be a make it or break it for you?
Yeah, and it definitely has been. So I think it's always been important for us, and including, present time right now, to try to take more of a quality approach to the relationships versus quantity.
Right.
Just given our size and knowing that we want to stay the course, do our 3 to 4 deals a year, that we can be really focused on. We knew we didn't need to be best friends with 50 brokers. It was just not going to be possible, right? And continue to run our business. So we, kind of look to the markets first. I think we always took a top-down approach in the beginning, is find the markets that we really want to be in, and then go foster those relationships and invest in those relationships, and know that it might take us 6 months, it might take us a year, it might take us 2 years to get into that market, especially early on back in the Charlestons and Savannahs of the world, right? I mean, those were not easy markets to penetrate. And we identified, the key relationships at, the top 5 shops that played in our markets. And so let's put all of our energy into that. Let's not try to go tour every deal that every broker puts on the market and be one of 50 guys that are bidding on a deal and not be able to build any real relationship value. Where given our business and our goals, that we felt that we could fill our pipeline with our handful of 5 relationships, and now maybe it's 10 relationships at this point, but we invested a lot. We always took the calls. We always tried to get back to our brokers, give them a yes or a no, even though it might take me a little bit longer than most, because we're a little more annoying on the front end of a deal and wanting to really understand it, but to make sure that we can get back to you and say, like, hey, this one's not going to be a good fit, and this is why. And then up to and including, I was getting a little paranoid during COVID, not being able to be on the road and be in front of you guys. And I know that there's a lot of deals that are still going on during COVID, maybe that aren't a good fit for us necessarily, but you guys are selling deals and building other relationships. So we, I was on my way somewhere and made a list of, 15 guys that are my close relationships, and told Rebecca to kind of order, the best bottle of tequila and the best bottle of bourbon and put a note in there and get them out to our guys and let them know that I'm thinking about them, even if they're not thinking about me right now, and to keep me top of mind. And, and we try to do little things like that. Say thank you to you guys too, because you're critical to our business.
Mine must have got lost in the mail.
I think Tom might have stole yours, Chad. He better share it with you.
All right.
Yeah, we need a deal out of that market. Come on.
I know. We're working on it, man. We're working on it. We're working on it.
Then you get to pick whatever you want.
All right.
There you go. Jad will go wine.
All right. Wine's your thing?
Yeah. Oh, yeah.
All right.
Oh,
now
yeah.
I know. See, it's going in the vault. Christmas is around the corner.
I like it.
What does a typical day look like for you as far as like business day?
Yeah. Well, business and personal has been blended over the last few months for sure, a lot more than usual. We've had an office for the last 7 years that we actually just let go in the beginning of COVID.
Right.
So there's 6 of us in our core URS Capital, business. And then obviously we have all the site teams, but the 6 of us, we're on month to month. This wasn't going to be our office forever. I want to eventually settle down somewhere that I want to own in our town. And we let our office go in in March, and went completely virtual. It's been fantastic. Our team's been great. For me, I'm an early guy. I'm not good late in the evening. So I get up 5 o'clock or so, buy a cup of coffee in the morning, check out CNBC. Kids get up early, 6:30, 6 o'clock, get them out by 7, hit a workout and on the computer by, 8:39 till about 3 when chaos starts again and they get home and dogs barking and kids are doing homework and time to get them to hockey practice. And then, usually on the road, normal times, it's been a nice break, honestly, during COVID. Us guys from New York, we don't have the luxury to jump in a car and go look at deals. We're on a plane pretty much every week. So it's been a little bit of a nice break.
Yeah, I agree with that. I think there's another time that we'll have in our careers to where it's been acceptable to not travel for a year.
Yeah. We were hitting it really hard going into COVID. I mean, to the point where it was almost like burnout time between the rehab projects, the new development stuff. We were on the road every week for at least 2 days a week.
And you guys are, like you said, you're nimble, you're small. So it's you and Lisa take on a lot of that workload, right?
Yep.
I guess, what are some of the most significant successes that you've had to date?
I think just taking the business from, buying $20,000 houses to, I think we've done over 4,000 units at this point, close to $400 million worth of deals. And that alone, and, we had our 10-year anniversary last December. So I marked that as, no one single success, but that combination to get to 10 years and, make all the early sacrifices pay off and still have a great runway ahead of us. I think, the 10-year anniversary was a big milestone for us.
That's huge. And no failed deals, right?
Oh, man, giving me the, as they say in New York, the Maloika.
Better knock on wood, man.
Knocking everywhere. No, we've had we've had some challenging deals for sure, but we've stuck with them and, came out okay. Thank God.
Yeah.
Well, I think, and this isn't really a question, it's just a comment. Like, I think your biggest success is really in your relationships, because you talked about it from your investor base to your construction partners, to brokerage relationships, to your, first communities and all that stuff. And I mean, it just reiterates what we always know about real estate is it's a relationship business, and whoever does the best at building those relationships and leveraging them are the people that are usually the most successful in our business, right?
I couldn't agree more with you. Yeah, you're spot on. It's not about the deals that you do. It's the relationships you build, right?
Where is URS going to be in 5 to 10 years? You going to be on a beach?
I don't think we'll ever be on a beach. I think we like what we do way too much. I think we'd like to get to a point where, I don't think the deals necessarily get much bigger. Mm-hmm. But if we can consistently, do one new development every 2 years, continue to acquire our portfolio, I think we're shifting the portfolio a little bit more into a, longer term mindset than we have historically. We kind of cycled through a lot of the portfolio that we didn't want to hold for 10 years.
Right.
We've sold out of, thankfully, prior to COVID and one during COVID. we're in a really good place to build a nice sized portfolio. We'd like to get to a place where we're consistently, operating 5,000 units, give or take. We feel like that's kind of the optimal number where we can sell some deals in a year and still have good scale where, when we're hovering around 2,000, you sell 2 deals in a year, that's, 25% of your portfolio.
Yeah, it's tough.
And you feel that it makes it tougher to kind of move staff around and the asset management side and to maintain that scale. But I think for us, it's, we're still kind of figuring it out. We just had that discussion last night, Lisa and I, kind of resetting the North Star, and it's keeping our head down and not doing stupid deals for the near term and just continue to accumulate, I think is really the goal over the next 5 years.
Yeah.
And have that pay its big rewards, 10 years out.
I think with the development, right, a lot of, or some of what you've been acquiring recently is even a little bit newer product and not just the 70s product that you've historically bought, right? Is that on purpose or is that just the deal popped up? And
usually the newer deal follows the really rough deal that gives us a lot of aggravation.
Yeah. A little breather.
We need it. We're like, we can't do this again.
Yeah.
We need it. But that's, I'm joking, but that's really been by design, right? Is that we don't try to take on 2 or 3 Nova Ridges at one time. Right. That, 2 or 3 really heavy lifts at once. We try to do that heavy lift. And if we can make it work, we try to do a deal like a Destination or a Moss Point to follow that. Something that's a little more, we can play offense from day one. As much as the allure is there for the nicer, newer stuff, we're really good at those deals. So
I agree.
If you looked at our portfolio, you'd say they're probably the most confused investment group out there, from new development to vacant 70s and everything in between.
So going forward, like you've historically been mostly Southeast and Midwest markets, right?
Yeah.
Okay. So going forward, I guess just a couple of questions. What's driving your decisions into what markets you want to be in the next 5 to 10 years? And are you accounting for any sort of like lasting population shift because of COVID and all the other crazy stuff that's happened this year, right? Is that factoring into your mindset as you go to target some other markets going forward?
Sure. I think for us, we love the Southeast, and, we've been, again, very disciplined to not kind of cross over too far west, because I like the ability to be able to wake up and, get to a deal on a day trip if I need to very quickly.
Sure.
And I think there are going to be lasting effects from COVID. I think will probably end with somewhere around 10 to 20% of the workforce working remotely. I don't think it's going to be anywhere near as significant as we're dealing with now. But I think that, is going to lend itself very well to the continued growth of markets like Charlotte, Nashville, Greenville, Charleston, the entire Southeast, and obviously Texas is a big benefactor of all that. For us, we've strategically gotten a footprint in Charlotte, which was really important to us. That's something we've been working on for a long time now with Rock Hill, Nova Ridge, and Destination. We've kind of got, a good foothold here. Our next area of focus is going to be the Nashville MSA. And we know it takes time, right? Because we're not that big institutional fund that could just go gobble up deals to establish a presence. It's got to still be a good deal for us to enter the market. Right. So we know it's going to take time, but we also know that it's worked every time we've done it, where we put the time in for whether it's a year or 2 consecutively into that market. When we land that first deal, we end up landing deals 2, 3, and 4 fairly quickly to solidify our presence in that market. So for us, Alex, I've talked about this, at length. It's really Tampa, Nashville, and the Raleigh-Durham market. That's our 3 areas of focus where we don't currently have a footprint that we want to be in the next, 1 to 3 years.
I think we can hit some rapid fire questions.
Oh boy.
Jack,
right.
You want to start it out?
Yeah. Okay, here we go. So what's the best book you've ever read that's impacted you?
Think and Grow Rich.
What is it?
Think and Grow Rich. It's the Bible. It's a book I always pull out. I was a big reader, but it's not an easy one. It's not a fluffy one, but it's the Bible if you want to build something.
Alex, have you read it?
I have not.
Right.
I got to go read
Another
it now.
Christmas present for you guys.
I'm writing it down right now. Yeah.
It's not going to be an easy, light read, but it is the book that I pull out whenever I need that mental training and reshift.
What's a piece of advice that somebody's given you that's helped you get to where you are today, or that's made a lasting impact?
You only get one shot at your basis.
That's a great one. I've never heard that.
Which
That's
is
great.
why I'm the pickiest buyer you have.
That's all right. I've sold you 2 deals this year, so
yeah,
I'll take that kind of picky.
All right. If you can go back and change one thing in your career, what would it be and why?
Oh man, probably would have bought more deals. Obviously, back in 2011 when we hit the point where we were buying real deals, 100 to 300 unit deals from 2011 to 15. I wouldn't have been as ultra cautious as I was. I would have done more deals and/or bigger deals earlier.
What is one thing that you've yet to accomplish in your that you want to pursue in the future, business or personal, either way?
I'd say it's more on the personal side, on the philanthropy and charity side. Really want to get to a place where we can either fund and/or our own or support a charity or a nonprofit focused on addiction.
All right. Alex has very young kids. I have very young kids. Your kids are a little bit older. What's the biggest challenge of juggling work and family?
So, listen, we got our kids involved early. My son was 1. We didn't have an option. He was in my office from, 6 months on. He was on planes with us from early on. I think you have to, you can't try to be everything all the time to everyone, right? So, when you're working, put it all in on work, but then when you're going to take that time to be with them or take them to hockey or coach a game or ride a bike with them, don't be out there like, 90% of us like this, like how you doing, trying to push them along. I think and it's taken a while to learn that for me. But it feels great when you do, when you can just leave your phone and go outside and hang out for an hour or two. I think that goes a long way too with the kids.
Agreed. Definitely agree. Is there a deal that you have owned or that is like the thorn in your side of you shouldn't have sold it?
Yeah. Ashley Village. You see the trade that just went down on that one?
Yeah.
That's probably the one that was, it's so hard because each deal that we sold at the time that we sold it meant so much to us for where our future, where we were at that time and where it was going to help get us in the future.
Right.
Right. So I try not to look backwards. I'm a big, so what, now what? But I would say that and/or Plantation Flats would be the one that I probably wish we didn't sell.
I was going to say probably Plantation.
Yeah. The only reason I said Ashley Village because the freaking number that just sold that, it's very hard to stomach.
Chris, thanks again for being here.
Awesome.
Pleasure.
I appreciate it, guys. Thanks so much.
Yeah. Thanks, Chris. It was fun.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios and video production by Yash Mystery of Mystery Projects.